None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everybody. It is Friday. How does this happen so fast? I feel like I just did Friday's show. Anyway, it's interesting doing these shows every day because it, I don't know, in some way I feel more connected to the business by doing this and feel like I'm talking to a lot more people than I usually get a chance to. Probably am touching where I think we're close to exceeding about 3,000 views now on our site. So that's good. Anyway, lots going on yesterday. What the big news of the day wasn't anything to do with economics. It was the crazy Iraqis running around chasing each other and blowing up and taking back over the country and removing just about everything we thought we did. I have a friend that was over there and didn't get wounded, but yeah, it's tough to watch. He had some interesting comments, but the bottom line is that's the geopolitical risk seems to come in, and every moment seems like the end. You never know where that thing could go with the Iran sending troops and all types of clashes there. We can pretty much count on the U.S. not making very good decisions right now. That seems to be what happens anymore. But the markets are looking at it and don't really care today. They cared yesterday. They only care half as much today as they did yesterday. So we're seeing a rebound. I talked about this in commentary that I thought we'd see a rebound in the action here a bit today, and we see some upside. We are seeing that. We're trading right now at 34.30. The range was 35.60 to 38.55 was the target range for the upside today. We'll see how it can trade. Some other things in commentary that I discussed. The market would have to close over 1949.44. That was actually last week's close. It needs to get there to really set up some kind of bullish tone. So my expectation that would be a pretty substantial where we are right now. That's not going to happen. Therefore, we're probably going to close in a neutral range with some moderate downside as it goes. Let me go ahead. We're going to go over to our market screen. I'll bring in Mitch here. Good morning, Mitch. Yeah, we were talking about some of the things we could do today to bring in some more perspective, and for one reason or another, it seems to be some of the what we call system noise from you folks out there. Things that we're hearing is a lot of interest in the countries, and I think we're going to do a combination of things. We're going to go through the country ETFs today to discuss what's going on there after we do our typical review. But as you saw on the schedule, I'm going to get over and start to do some of the market reviews so we can see what's going on this morning, see what's going on and what's changed and hasn't changed. There has been some slight movements around, but nothing material as it would go. But we'll go through some of the countries and look at those things, and I think we may specifically look at maybe the pigs and maybe some of the other folks. That's what Portugal, Ireland, Greece, Great Britain, and Spain. Pretty good. All right. double G in this pig. So not sure what that means. All right, so let's go ahead and then let's start some review here. There was some news that came out. Mitch, what was we had the sentiment, consumer sentiment come out? You know what? No one's actually hearing you, Mitch. I'll tell you. Let me just get Mitch on board here, because I didn't do that right this morning. I thought I did. So let me. I realize that I'm hearing you perfectly in my headsets, but I'm not hearing you at all. So apologize for that, folks. Now you can talk.
I can talk now.
Yeah, it's really loud talk. So, but anyway. So now we're live. Sorry about that, folks.
All right. As I was saying, today the University of Michigan consumer sentiment came in at 81.2, which was just below the consensus estimates of 83, and I believe it was also lower than last month's estimates, or last month's sentiment. So
and then jobless claims came in higher, like 317. They were 313. They were expected to drop like 3,000, but no one cared about that yesterday because of the Iraqi situation. So that's pretty much as it would be, I guess. So let's, so the news, as I mentioned in commentary early on Monday's commentary, there was virtually nothing coming out of any significance this week. That proved to be true. We got a little volatility. I've been talking about the 3-day volatility indicator, and that has actually gotten increased a little bit. It's at 1104 today, because we saw a little bit of increase in that yesterday. It was all the way down to 780, which was pretty contracted. So we've seen a little bit of volatility increase, but it's actually contracting today again. So we're a pretty low range. So one of the things we'll take a cruise here in the futures markets and take a look at. This is the 5-minute graph. We had a nice cycle come in. This is where the bounce came in. There was a this is a 24-hour chart, so there about 4 in the morning Pacific time, so 7 a.m. New York time. There was a little bounce here, and then another secondary bounce right after the open. About an hour after the open, we saw it bounce there as well. About another hour or so to the next hour and a half to the next cycle, and it looks like that may be a low. Maybe we'll get another surge later in the session. The hourly futures shows a similar pattern. We had a little earlier cycle come in. This is looking like we're trying to get the market moving. I've talked about this, haven't seen this pattern for a while actually. There's what I call a veil above this. Let me show you. And this is going to inhibit the markets from going too far right now, from the standpoint of these right here. I'm just drawing. There's some. These are exponential moving averages. When they get inverted like this, you can see when we're trending over here, the market kind of trades in it. We get these veils. It kind of limits until we get back into that pattern. We're trying to get back in it, but it looks like there might be maybe another little rollover before that happens, and see what goes on. But as I mentioned also, from a cash viewpoint, let's get over there and take a look at that real quick. And if we look at, here's the weekly, but let's get over to the daily graph here and take a look at what's going on here. The daily graph came down yesterday to the 20. Was this 20? Let me bring this up on the screen so you can see this. The 2578 level was the low. I mentioned in yesterday's commentary, not today, but yesterday, that if it took out 1932.30, we would see it move down to the 1925.60 level, possibly as low as 1921. So we actually bounced off of that support zone, and I was shocked that we got through where we did, but it was almost markets viewing it almost as a mistake, as we're seeing a rebound back into above that level, above that 1332 level today. So I would be surprised if we don't remain above this level and see some further strength later in the session here today. But the bottom line is this support held, and the pattern, you can see now the PPM 1, 2, and 3, we're looking at 0.06. So a lot of the upward momentum that I talked about 2 or 3 days ago has dissipated and it's flat. We have 0.11 and 0.09 on the other two. So we have a slight bias to the upside on a short-term basis, but not a lot going there. And as I usually go through and look at the PPMs on the weekly basis now, we'll see PPM 1, 30, 0.37, 0.24, and 0.38. All of these, this lost a little bit. It was 0.43, I believe, earlier in the week. Matter of fact, we can look at the peak right here. It was actually as high as 0.49. So it's pulled back a bit, but this is still well within the ranges of expectations from the standpoint of what a trend would be here. So we don't really see any breakdown, no material breakdown, just from a little bit of softness that we saw for a couple of days. It's reflected in the indicators, but nothing that's material or looks like it's going to move around anything significantly. I want to go and see if I can spread this pattern out a little bit. What we are seeing is, after making the breakout move last week and moving up to the 1950s level, mid-50, 1955, we are seeing a little back tracement, but it looks like it's very possible we're going to go out around the middle, maybe on the lower end of the range for today, but not a lot there to be able to really target and talk about. And since the end of the week, we'll take a look at our monthly graph, and we're continuing 167 on the PPM 1, 142, and 101. So these are all very robust numbers. The trend's not going anywhere. Still very much alive and expanding as it would be. So we should continue looking at some of these targets. Let me bring up the go back to the weekly and bring up the whiteboard so you can just see these targets that I've been talking about. We're very close. This first arrow I put over here on the far right is actually the 1973 number I've been harping about for the last few weeks. You can see about 4 weeks ago when that pattern popped up. So that's when I started discussing that the upper end of this range is 2032, 2072 is on the upside. As I've talked about, from these ranges, that's about 4 to 7% range from an expectation standpoint of the market going higher. The numbers are sounding bigger than they really are from that standpoint. So from a index viewpoint, from a U.S. index, not a lot has changed. Momentum, we saw short-term momentum has flattened out and is neutral, which suggests that we could see a little more consolidation. Just taking one last glance at the daily graphs here before we move on. This is pretty typical. We get this move up, a correction, come back to moving averages, and then we should see the market resume on the upside probably early next week. There's since the high, there's 1, 2, 3, there's 4. Probably one more day in this pattern from a consolidation phase, and then we should see another 5 or 8 days up. So next week it looks like, even though we're not going to get any great positive close, that there's some possibilities for this thing to move up higher. We'll take one quick glance into the minutia of the market, and just to see what this looks like. This is the hourly graph on the S&P cash, and you can see we're setting up a bottoming pattern. We're still negative, very slightly negative on the PPM 1, 2, and 3. Not a lot there to look at the moment, but that certainly is a place where we're going to see this pattern probably stair-step back up. It looks to me that it's going to attempt, if we get over the looks like 1940 level would be the key number today. And as I mentioned earlier, 1935.80 to 1938.05 is kind of the upper end of the range. The extreme resistance for today is 1941.15. Don't see us getting there at all. So that's about it. So a couple of things. I guess moving on to the taking a look at the Treasury market. Let me go ahead and bring up the 10-year here. This is the weekly 10-year. We're at 2.60.8. Talked about this, just not likely for the market to get above this 262, 264 level right now. It's going to be resistance. There is some of the downward momentum has dissipated a little bit, but not a lot. So we're looking at ppm 1, 2, and 3 minus 0.45, 0.39, and 0.30, all trend levels to the downside. So there's still a lot of pressure for rates to remain low from the standpoint of getting through this resistance. This doesn't appear to be the way it's going to set up to move out of here. And there's not a lot going on. I don't even know that it's worth looking at the short term. Maybe we can figure it out. We did talk about this on Wednesday, where we saw a new signal for rates to go up on the daily. It's still positive with short-term objectives here, bringing that up for you. Short-term objectives, Fibonacci objective, 277, 286, 292. And I'm not sure we're going to get up there, but it's certainly because of the weekly charts and the resistance at the 264, 268 level, it's probably not going to get through that at the moment. This will probably be more, as you can see, this chart is just consolidating over here on the right, and we've been locked in that range at 260. I'm not sure what the highs have been here. Let's look here. It's been, yeah, here we are, high 265.5. So we've gotten up into that range a little bit, but not much. Like I said, that's the big resistance area. 260, 264, 268 is going to be where this thing stalls, and that's what it's done so far. A few more days of consolidation, maybe another week of consolidation, we can bleed off some of that downward pressure on the intermediate charts, and maybe we can see rates move a little higher. But for right now, don't expect much from any of that. Looking at, let's go over and take a look at my favorite currency, and that's going to be the yen here. And just continuing down, it's down about a little less than what it was up, about 0.45 or so yesterday. Today it's down. So this little sideways pattern is continuing. I'm on a daily chart here. Let's go to the weekly. See this pattern a little better. It's still in this long position here, waiting for some movement to the upside. Still expecting 110 plus out of this. I know that you guys aren't currency traders, but it's certainly a place to look. And I think when we go through the countries, I'd like to bring up Japan, because that's been a pretty good place to be as well. All right, moving on. Let's take a quick look at GLD. I wanted to look at this together with you folks, because I felt like I saw something this morning. I was looking at things early on, and I'm going to go to the monthly graph. And it's interesting, because this consolidation that we're seeing here on the monthly is setting up a pretty decent pattern here, which suggests that this market's probably going to move up sometime. And now this is a monthly, sometime probably later this year and maybe early next year. So I'm not sure what's going to drive that higher, but it certainly looks as if that is going to be the pattern that is setting up. Let me get the whiteboard out here so you can see this. And this pattern appears to me anyway to be setting up pretty bullish. So we got this little pattern here. There could be one more down. This would be the alternative for me, but my expectations would be that this thing is going to come back up here and do some sort of retracement off of these highs. And whether it's I think the expectations, we talked about this in the last meeting, where the expectations was for a move off the annual report that we did was still 1430, 1450 range, and that still looks like it. And sometimes the timing's kind of tough to tell when these patterns are going to emerge, especially on a monthly chart like this. The weekly chart looks almost like the yen. Looks very similar, where it's just been in this position, and we are getting somewhat long in the tooth with this particular position. We looked at it on the on VPM 2.0 the other day, and it is getting pretty long in the tooth, but the pattern itself is bullish. So we could actually see an exit, a small loss, and then a re-entry when this thing breaks out if it continues to consolidate here. So yeah, as I mentioned, I guess if we got out of this trade, it would actually be good if that happened, because that would mean that the vulnerability to the downside of that one more low would be there. But overall, the pattern is pretty bullish on more on a long-term basis than it is on a shorter intermediate-term basis. It's neutral on intermediate, and slightly if we go, I don't think there's a good chart. Oh, there will be. This is GLD I've got up here. So you can see, actually, it's interesting. We just got a buy signal for today on gold on a short term or a daily. So we are seeing this movement up, and we're looking at 0.18, and then the other two ppms are both negative right now. But I don't. That's how it should look when it's setting up a low. So we'll continue to monitor this, and it's interesting that I hadn't looked at this from a VPM standpoint this morning, that there was a new signal right here to buy this on a daily basis. So onward we go.
Bob, we also got a request for the Market Vectors Gold Miners ETF, GDX. Would that be a good time to talk about that right now?
Yeah, let's do that. What is it, GDX?
You got it.
Okay. Short term, we got a buy just a couple of days ago. Let's take a look at the typical range. So this thing's looks like gold. Now, what is this again?
This is a gold miners ETF, so instead of actually working off gold, it's the actual stocks. And this is trading on the 3.2 system as the optimized trade system.
Let's see what we got going here. Good call. That's on 1.2 right now, so let me go ahead and put 3.2 on there. So I see it just exited on 3.2.
Yep.
Recently, yeah. Similar trade, we're just talking about gold. A similar type setup is that you might have to get an exit before this thing comes back in. And the next trade, I wouldn't miss out on that for nothing. The next signal comes out, it should be a pretty good one on this, especially if we stay in this consolidation range. And the patterns were set up, we just didn't get it to maintain the right kind of support levels to maintain this.
I know some advisors have liked going with the gold miners as opposed to actually working with something like GLD. Do you have any thoughts about working with the gold mining ETFs or stocks as opposed to actually using an ETF built around the commodity itself?
Yeah, the stocks have been terrible, but we'd probably almost have to look at the stocks themselves to really come up with some kind of understanding of that. But in the past several years, the stocks haven't been a place to be when the metal has actually performed better than the stocks, but maybe it's time for the stocks to go. There was I saw some way back when, 1990s, I had a group that worked within my office that was specialized in gold hedging. We had several big gold miners that were hedging, and I think a lot of these guys have hedged off a lot of their risk. And if that's the case, and if the metal does start to move, they may not get the initial benefit depending on how they're positioned. We've seen that happen in and some of the oil producers, but it seems to happen more at the gold miners in the past. But like I said, I don't know a lot about the fundamentals of these stocks, but this pattern to me looks like the next time the gold goes up, it looks like they all want to go together. Which one will be the better of the two is kind of a tough call.
Right.
But yeah, so I don't really see a way to make that call, I guess, from the standpoint of what the configuration looks like there. So anyway, yeah, no, that's but that would be my feeling on that GLD versus that. I really, maybe we get a retracement back to this $50 level, so maybe there's 30-40% on the upside. The gold has about the same upside if you get back to that 1450. So I don't know who's going to lead what there.
Okay.
What was the other one? I know there was another.
Yeah, the other one was the S&P Home Builders ETF. Ticker is XHB.
Okay. And what's
1.2 on that one.
Of course. That's the way it would always be, right?
Yep.
So out of that recently, see what. Take a look at the. I just want to see the trade list here. So that last trade was a slight. Let's see here.
Slight gain.
Yeah, 13 cents. Not a lot to deal with. But when you look at this pattern here, it's been pretty. Most of the money was made going back. This is a weekly good. Going back on this trend, and now it's trying to break out. Whether it's going to go much higher or not, it's hard to say. It looks like there's a reversal pattern going on right here, right now. Let me blow this up here. Looks like a downward reversal coming right now. Negative PPMs 1 and 2, positive 0.22 on the 40, but it looks like everything's trying to fail here. So it looks like downside for this index. So that sell signal was looks pretty good. I wouldn't want to be in this one, especially with this reversal pattern. It's a little more dramatic than what we're seeing on the index this week, and I think most of the recovery, at least from the viewpoint, a lot of the recovery that's happened in this industry has happened. They can't seem to get out of their own way at all anymore. I don't know what other areas in the country are. I have some views. There's actually a fair amount of building going on, but we're still only about half of what we were once upon a time.
Yeah, out here in the Twin Cities, it seems like they're still building up more and more of these townhouses, and I don't know where the people are going to come from to fill these up.
Yeah,
a lot of people wanting to move to snow. Yeah,
multifamily has been the big growth. Matter of fact, I think the last new homes report that we had, something like 60 or 70% of the new permits that were issued or new starts were actually multifamily, and a combination of condos, but even more so toward the apartments. And that continues to be a trend. Home ownership, after everybody got spanked on that last deal, is not very, very exciting anymore. Matter of fact, I was talking to some folks the other day, and we all there was a group of us talking that were realtor in the group and some designers, and we were talking about real estate, and anymore the expectation from most people in the markets are if you sell, hope to get your money back. You're thrilled if you get your money back. So it's not like the days where everybody wanted to own real estate and do try to do that, make money and with your house mode. So anyway, let's go ahead, and I just realized this wasn't full screen. That will actually make things even more useful. So let's see here. We're about at our time. We're 9:30. One of the things that I continue to feature, and we'll go through some of these. We'll start with these ETFs, and I want to continue to talk about some of the differentials. Mitch, were you ahead of the game enough to figure out what models go on these?
Of course.
And you stacked them the right way, right? So
I can do that within a second.
Okay. So yeah, so what we want to do is we'll go ahead and go through these ETFs from, market has moved higher while I was talking. We're now at the 1935.28. As I mentioned, 1935.60. Let's take a quick glance while we're getting ready for this next segment. We did hit, looks like, 1937.23. Let me get to a different chart here and make sure I've got the right one going. Yeah, so we managed to get up a little bit more while we were talking, and we got right into that range. So 1938.55, if that comes off, then we've got some shots at some of the things we were looking at earlier, at this market getting over 1940 and continuing to erase a good portion of yesterday's declines, actually. So that's sort of interesting. I think overall the pattern is going. It'll be, I think the last hour or two of the day today is going to be interesting to see if there's anybody fearful of the weekend with this Iraqi situation, with some global risk out there, with some, geopolitical type stuff going on. I wonder if anyone's going to be squaring up books. Well, that last hour will tell you a little bit about the fear. And we're back on the VIX here at $12. So we got down to 1070 the other day. That's the lowest we've seen in multiple years. I don't know how many, but it's the lowest we've been. So, all right. So let me go back to this other chart here, and let's go ahead and before we get on to the pigs, what's the ETF for Japanese? I want to look at that.
The Japanese, the MSCI Japan Index by iShares is EWJ. We're currently flat that position on the 3.2 weekly system.
It's weekly, and I have. There we go. And that was a profit that we took from a position way back on. We bought it at 974 back in November of last year, and now we sold it at 1193. So decent profit there. But so this market has been. Let's take a quick look at a long-term view of this. You can see this market has been, kind of in this range. In 2006 and 7, it never got up to its highs of 2000. And of course, this is the great experiment in QE that was started way back in the 80s. And you would think before the rest of the world went down this, they would have taken a little glance at this. This economy has been locked in this range forever. And we may be as well. It's the ongoing theme from the stock market viewpoint anyway. May be, stock selection may get even more critical than what it has been. I think it's been pretty critical in the last couple of years. The only way you could really add alpha was really to do some real good selection.
Yeah.
And there's just nothing out there. Indexes are going to be, they're going to, last year was a good year. There's going to be, hopefully there's a reset so we can get a good feeling for that. But this Japanese on a long-term basis certainly looks more encouraging. We've got some positive PPMs, 1 and 2, 0.84, 0.17. One of the issues is here that the 21 or PPM2 is moving up faster than the other one. So get full screen here so we can see this a little better, so we're not in there in the way. But you can see these PPMs are moving up. So anyway, let's go ahead and were you able to find good stuff for all of the pigs anyway?
Yeah, I mean, obviously it's a little difficult to find ETFs for all of these, but Portugal and Greece I think are the two shortest ones. The others have been around for a while. And just a side note, I did actually create a portfolio of my own account around these ETFs, and it's really interesting seeing how it compares actively managed going back, I think, to 2009 or 2010 versus buy and hold. And point to point, they end up at about the same spot. What's interesting, though, is the road to get there is very different because of the large pullbacks that we saw over those years as there was so much concern in these spaces. So it's just something I'd encourage you, if you're curious, go ahead and build out a portfolio of this, and you can see what this looks like. To get going, though, you're already on the 3.2 system, right?
Yeah, what I'm doing is I'm setting up a glance. I think we ought to build that portfolio here.
Okay.
Real quick. And 2267.
All right, give me 1 second.
No problem. And I think we'll build this out here, and we'll do that in a minute. I see you're driving or trying to drive.
I just want to make sure I could.
I know you. Okay, so anyway, I think what we'll do is we'll go through some of these, and then when it's done, we'll go through and actually build that portfolio, because it's only going to take a couple seconds here. There's
Right.
5 of them or something?
Yeah, there's 6.
Okay.
So we, since you're on the 3.2 system right now, let's start with Greece, GREK. I think this is the youngest of all the ETFs that are out.
Yeah, this is the weekly, and the unfortunate part, we're going to have to bring this up, and this will not show signals because
It's too young.
Because I built something into VPM. VPM has a very unique way that it handles data, and one of my partners, original partner in this business, was a programmer that worked with me, came up with a concept which we seed the data. So this needs too much data to make the calculations to be able to generate the signal, and that's one of the downfalls with this platform versus ours. So we'll bolt over real quick here to let's go and just bring it up so we can see that in VPM 2.0. What was it? GREK, you said?
You got it. Yep.
Okay. Let's take a look at this in 2.0. VPM can actually make a decision on a chart if it's a weekly chart 1 week after it comes. Actually, it could come out on Friday, and it's capable of making a decision for the following Monday. It needs at least 1 day of this week to be able to start the calculations, because of the way that we handle the data, the seeding of the data. On a daily, it takes 1 day. So if there's an IPO comes out, there's no data right now because it just came out today. At the end of the day, when we run that, after the second day, so it takes the initial day and 1 more day to make a decision on whether you want to buy or sell it. And I know that back in the day when Google came out, we bought it the second day it was out. Of course, we all know the Google story. Everybody was excited about that. But here, let's take a look at the Greek actually showing that it's a brand new buy here coming out.
Yep.
So
yeah, one of the difficult things with this as well is because it's so young, we haven't really found a good optimized trade system. Right now it is defaulting to the 3.2. The ER ratio on the 1.2 is slightly higher, but they're both still showing a poor in this space.
Right. And one of the things that happens here, and this is a good point, is because it can make this quick decision over here, the ER ratio is poor because it usually takes between about 4 to 7 trades in VPM to get enough data to make a decision to actually profile a stock. So something like this has it did a good job capturing this last little trend when there was one, but it's pretty choppy in here. So this has got how much data? About 2 years. 3 to 4 years is about the best time to have. If it's a ETF or a mutual fund that they've done a clone fund, maybe it's closed and they put another one on, then you can go ahead and use the new one, understanding how the old one did. But but for the most part, 3 to 4 years worth of data before you get enough material to do that. But I wanted to kind of get a better idea, at least where the signals. So I brought up 1.2 here. Go back and put 3.2 up real quick, and 3.2 is, as Mitch pointed out, this has got a, what is the ER, 35, and then
the other one's 55.
Yeah, so
they're both pretty miserable, but it's classic Geico in this case.
Well, yeah, you just don't have enough to make the decision. You got some spikes in here, so maybe you could pull up a daily 1-2 and do a better. No, that's even worse. So let's try 3-2. It does have a good rating now, so just a lot of choppy patterns in here, but so Greece not a lot to offer from that viewpoint, but certainly. It wanted to get a perspective from where we are here on TradeStation anyway. So let's go to next symbol.
Next one on the 3-2 weekly is Great Britain, EWU.
So there was no EWG for Greece out there, huh?
I guess not. Let's see what that is.
EWG, what is that?
That's Germany.
Germany, okay.
Oh. I believe it's Germany. Yeah, Germany index.
Yep, Germany. Okay, that makes sense. They deserve the G more.
They deserve the G.
Even though Greece is the oldest currency on the planet, when they were around, they had their very first currency out there. So what was it again? Now that I messed it up, what was the symbol we were going for?
EWU.
EWU. Which is the UK, huh?
Yeah, I suppose.
And let's say so much for the double G, right?
Yeah.
Let's see here. So what model we got here?
It's 3-2, so we're on the
Okay.
right. We should be on the
Okay.
right one.
All right. Yeah. So we've got a current position here. There's some Fibonacci objectives that are playing out right here. This has been a fairly choppy market, but in the last let's say last several months, there's been an in and out, in and out. The old story: got to do the third trade to get to the good one. Old lesson learned on the trading floors many years ago. You got a good idea, don't give up on it. Sometimes it takes a couple times to get enough traction to do it. This particular chart's about 2011. 2010, a little goes back a little ways. Might be able to even squish this down, yeah. So there was a pretty good trade back in right here where in 09 had a nice long trade, and then Great Britain's been pretty choppy. They have a Canadian ex Goldman Sachs guy running the central bank there now, which I still think is interesting. But the pattern is pretty bullish here. If I bring up this pattern here, if we look at what's going on, the high target is 2368, 2403, 2310 is the minimum. Let me move this out of the way so we can see this. So we're above 23. We're not quite up to 2310 yet. So this pattern looks like it wants to accelerate. We got a plus 55, plus 20, plus 31 on the PPM. So we got all trend modes for the most part. The PPM2 is lagging a little bit, but what we're seeing here is when you see the PPM1 is accelerating faster than the 2, that's an expanding trend, because the short-term averages will move away just because they're responding to the price action a little faster than the others. So when you see that expansion, it tells you that the short-term trend is actually expanding, and therefore it will pull the other averages up, and you'll get into the full trend mode that I've talked about in the past, where these three averages really spread out, and then they get to kind of a peak momentum, and then you start to see the PPM2 go faster than PPM1, and that's the beginning phases of a correctional phase or a top, depending on what ends up to play out. But so this one still has, looks like another maybe 10% on the upside. I don't know what the current. Can you see, Mitch, what the current P&L is on this one?
Yep, that's what I'm pulling up right now.
Okay.
Yeah, so we're up 4% in it right now.
Okay. So, yeah, we'll probably see more of another, there's about a 15, maybe 18% gain depending on how this thing plays out over the next couple of quarters. But that one looks pretty good. Let's move on.
All right, we're going to switch over to the 1.2 trade system. Here's another young one, PGAL. So this, I think this has only been around for a year.
Yeah, that's not going to work here at all.
So it won't be in that one. We'll have to use 2.0 for this one.
Yeah, and that's, okay. We'll do that. There's 2.0, and let's see here. And what is it again?
PGAL.
PGAL. Yeah, so it looks like it bought it and got out, and so it's got one trade. So that it's got a good trade on it. So ER is 100 because it has no losses. So it's going to be, it's 100% correct at the moment. There's no ratios, nothing. It just has one winning trade. And by the way, if you ever bring up a symbol that's new and you see a symbol that's not, the best way to put it, it's got a negative ER, and you look at the trade log, and it's, maybe it's one of these new trades, and it's just the symbols chopping around. It could be a stock, it could be whatever. And what you're seeing then is just a reflection of it not having enough trades to actually calculate the ER. It can't calculate until what the ratio is until there's at least one winning trade. If you have all losing trades, it's actually, I think it's going to be 0. You get nothing. It shows ER 0. So those are one of the things that happens from that standpoint. So Mitch, why don't we? I'm going to bring up. Why don't we build that portfolio real quick, because we're going to run out of time if we don't, just so we can discuss that.
All right. Let me see if I can drive real quick.
Okay. I'll let you do it now.
All right. So as I said, it's PIIGS. So we've got 6 securities in here. And all I did is I left the defaults on most of this. Started with the default inception date. Now, as I already mentioned, 2 of these ETFs just haven't existed this whole time. But just for this quick and dirty portfolio, we're just going to go ahead and work with that existing inception date, just because 4 of the 6 have existed long enough. Because we are working with ETFs, I'm going to go ahead and set the activity liquidity settings to high. And I'm going to leave the average transaction fee as 0, because every good advisor should be absorbing their ticket charges. And what I'll do here, I'm going to go ahead and put in the optimized trade system on each of these, with the exception of the 2 ETFs that we already noticed don't have a good ER ratio. Those ER ratios that are below 100, what we're going to do with those 2 cases, we're going to go ahead and toss them over to the daily trade system. We'll go ahead and just put them in this bottom box. We'll let the system decide which of the daily systems it wants to utilize.
And you did that just because of the short stuff?
Yeah, because these 2 are so new. They don't have good ERs on the weekly. We're going to kick it over to the daily side and see if we can find something that has a better ER ratio that's been able to handle this shorter term volatility a little bit better. Yeah, and
I would probably do that differently. I would probably just build it and then change the start date on those things so the trading start date isn't and up the allocation early on. That's how I would handle that. We keep everything on an intermediate basis. That's certainly one way to handle it. You're certainly going to get trades, but
yeah. And part of the reason too is I already did what you just described, so I saw the results. So I am gaming the system a little bit in the sense that
you want to do it, yeah.
So I could show you what this looks like. So as I did with this, I didn't go ahead and put a management fee in. We could have easily put in a 1% or 1.5%. And then it came up with an allocation factor of 0.342, I believe. And now it's queued up to run.
Yeah, we can take a quick look at the high 0.3042 was the allocation. And so, so once again, if you build them, right now, matter of fact, it's already run. We hit it perfectly. So we can take and go ahead and bring this thing up. And this would have been, what do we got for returns here down here? Let me do two things. Let me toggle over, and let's make this a touch bigger so it's easier to see. There we go. So you got since 09, 21 minus 3 plus 1.32, which is interesting because that was the disaster year in Europe. And all of these guys, the pigs, were at I guess ground zero from the standpoint of what was going on from that standpoint. Yeah, so we've got I put me right.
Just to put it in perspective, on a buy and hold basis, 2009, if you had equal weighted these securities, you'd be up 23.9%, so about 24%. The following year, you were down 12% in 2010. 2011, you would have been down 15% on a buy and hold basis. And then 2012, we had almost the same return, 17.05%, so within a few basis points. And then last year, up 26%. And then this year, they're up about 9% year to date. So we're underperforming the buy and hold a little bit this year.
Yeah, but way ahead of the game.
Way ahead of the game. Yeah, because I did adjust this and put those two on the daily. It turned our 100,000 to 177. If I had stuck with the original weekly only system, I believe that grew to be 138%, 138,000, I should say.
Right.
So it made a significant impact using those two daily trade systems in that particular case, because the ER ratio just wasn't as good on those for the shorter term. But yeah, as you had already mentioned, Bob, if this was something that I was creating, first thing I would do is looking to shorten the time frame to the most recent inception date, and then see what that looks like, and see if there may be a slightly better performance if I'm willing to make those extra trades on some of these ETFs that just haven't performed as well on the weekly as they have on the daily.
Yeah, and what you could have done also, if you were an expert user, then you could have put them on daily, and then when there's enough data, you start to see the normalization of the data. You could put them in over on the weekly trading model down the road a little way. So that would allow you to do that as well. Okay, I think that was a good plan. I just wanted to show how easy it is to build one of these patterns here that we're talking about. When you take a simple concept and maybe I guess if you were really wanting to build something like this, you could build one of pigs, you could build a brick, you could build all the different things, and then do what we showed in Process Warriors yesterday, how to combine those, maybe blend those together, or you could put them all in one giant portfolio. But they might run better in individual groups than trying to combine them all in one giant group.
Yeah, and this is, you could use something like this in a number of different ways. It's a fun contrarian play, because of course everybody was talking about how terrible the pigs countries were, and obviously they did significantly underperform their peers in the international marketplace. But having this sell discipline in place, you could see when you build it out within your own account, you can see how we have these nice flat lines at the right times, and then we were able to capture the upsides. So even if this wasn't something that I would use with clients, it would be still a fun conversation piece with clients, just to talk about the whole concept. It's that buy when there's blood in the streets type attitude.
Our buddy Hugh Hendry'd like to have that track record, actually.
I bet he would. You should give him a call.
Yeah, he didn't come anywhere close to those kind of numbers. But let's go ahead and cover a couple more of these, something that's got some data.
Well, some of the other ones that are on my list, let's see. Well, Spain, EPW, that is part of the group. That might be a good one to talk about. That is the best performing single currency or single country ETF that I have on my list.
You need to give me another symbol. EPW?
EWP.
Yeah, okay. A little dyslexia there. I thought I was the only one who had that issue. Okay, so you can see this is, I talked about this. Boy, what a hindsight miss this one is. You can see PPMs are all screaming trend although we're starting to see some of that narrowing. So we're at a very mature trend on this one. This original buy way back here is, as a matter of fact, this is actually another good example here. You got to buy at 20. Let me bring this up so everyone can see it a little easier. So you got to buy at 28.58, and then you got an exit at 26.92. You lost, and guess what? You had to pay 28.50 to get back in, so you could make this giant trade all the way up to 43. So, you know, I guess that trade was failing there. We know in hindsight it didn't fail, and we bought it back in. Somehow, my favorite question is, well, how come it got out and then got back in? And it's because the patterns were failing there, and we only know in hindsight that it didn't go down there further, that it didn't fail. Here's one where it got in and got out. It kept going down. We didn't get back in. So that's another way to judge some of these trades. When it does get back in, what happens? And what happens normally is that second trade. So I've seen in some of these these elongated patterns where the market's going flat for a long time. I've seen those have a couple trades, and if you're fundamentally watching this, I mean, they're very immaterial. It's a $7 ticket, and it's not material to most of the accounts that you're going to have in there. They're just in, they're out. And then when they do get the right trade, it's big. So I've actually suggested, if you have a stock that has cratered out huge, like a Netflix is a good example. It went from 270 down to 60. If you put VPM 1.2 on it, which was the optimized model at that time, that first trade after these big collapses, I've seen this happen over and over. That first trade, it'll buy and then it'll fail. It's the second trade you want to do. If you did all the trades, you ended up fine. But if you did 3.2, it will miss that mental trade off of a collapse. So in 2009, it was interesting. Most of a lot of the signals that came out, 3.2 came in July of 09, and that really was the big tranche of orders on the security side that we had, and that was where the big trade was. So I guess scaling out of this thing here at the end of the day, let's go ahead and just take a quick glance. Market has decided to pull back from those levels. It went up to that resistance level. Here's a chart I haven't put up for a while, but you can see the intraday. We got up to the peak where we were talking about 15, 20 minutes ago. Got up there, couldn't go through, and now it's fallen back down. This is a 1 minute futures chart. This is my trading chart that I do for short term. If we go over to the end of day and we look at that cycle, as I mentioned, we are getting pretty close. Looks like about 20-25 minutes away from the next cycle low. So we should see this thing firm up and maybe give it another shot. But on the from an index standpoint, we did get up to let me get to this other page here. Let's get out of this one and get to here. And we did get to the 1927.69. I mentioned 1937.23 was the high. The range on the upside today, I mentioned in commentary, was the target was 1935.60 to 1938.55. So we got in that range. It's basically between R2 and R3, and the market's faded off of there to move lower. So with about a minute to go, look for this thing to try to firm up one more time. I don't see it going negative on the day, the way things are set up. So look for the market to firm up, close in a neutral range for the week below the 1949.44 level, and possibly closing above the 32.30 level, which was the pivot on the downside. So good week. I felt like we got things done really well on Process Warriors. I guess next week we're going to delve into some other aspects of utilizing VPM on that show, and we'll continue the Market Thunder show as usual, which is really about the markets and price movement expectations. And continue to send us in any stocks or things that you would like us to talk about on either show, actually, please let us know what's going on, and we're anxious to hear your thoughts and everything. So have a great weekend. Good Father's Day to all you folks, and we'll enjoy being with our kids and doing life this weekend. So thanks again. Have a great weekend.